you guys, Delvin Joyce.
My man. Appreciate you, brother.
I got you, boy. You know that, man.
Man, I love this guy. This is, when he says we grew up together, like we grew up together. We got it out the mud, right, Keith, as y'all like to say? So I appreciate y'all being here today. I've been so excited about this. I get to travel all around the world. Not the world, but all around the country, and I get to have conversations with people about money all the time. But my favorite group of people to talk to are young people. So I want to applaud you guys for getting up today, coming in here and getting this information because, again, thank you. Because there's so many other things you guys could be doing this morning. It'd be so much easier to just wake up, doom scroll Instagram, or play video games, but you guys decided to come here and get professional development. So this is amazing for me, so thank you. So I want to talk about a really, really important topic. Before I get into that, I want to make sure I know my audience. And is the mic too loud, too low? How am I? Is it perfect? Okay, perfect. So I want to know my audience. I know this academy is like freshman in high school all the way to sophomore in college. So if you are a freshman in high school, can you raise your hand for me? All right, nice. Sophomore in high school? All right, perfect. Junior high school? Nice. I got one of those. Senior in high school? Fantastic. Freshman in college? Let's go. Sophomore in college? All right. So we got a really diverse group. All right, the most important question, do we have any Giants fans here today? We got some Giants fans, all right. So when the food comes, y'all get extra dessert, okay? These two. Penn, make sure they get extra dessert. All right, so the topic of my conversation today is grow the bag. Who wants to grow the bag? All right, what does that even mean, grow the bag? Everybody raise their hand, but what does that mean? And somebody volunteer to tell me why you want to grow the bag. Anybody? What do you want to grow the bag for? All right, tell me your name.
My name is Michael, and I want to grow the bag so I can create generational wealth for my family.
Wow. Michael says he wants to create generational wealth for his family. How old are you, Michael? 16. Michael's 16 and he's already thinking about generational wealth. I love it. Who else wants to grow the bag? All right, my guy here. Tell me your name.
My name is Kelly, and I want to grow the bag because that's the only way to win.
That's the only way to win. I like it. Kelly's focused on winning. I like that. All right, one more. Give me one more. I like that suit, man.
My name is Jairus, and I want to build my skills to grow my skills.
To grow your skills. So, and it's Jairus. Jairus wants to grow his skills. He wants to grow the bag. We talked about investing in ourselves, right? So we have to grow the bag to invest in ourselves. Now, again, as Penn introduced me, I am a certified financial planner, which means that I help people get clarity with their financial situation. I help them figure out if my goal is to grow the bag for generational wealth, or what did you say? To win, or to invest in yourself and grow your skills. I help people map out a written plan for how to do that, all right? Because here's the key with financial planning. The first thing I'll say about financial planning, it is telling your money where to go instead of asking where it went. Far too often, we make money. I saw a lot of hands go up when they asked if you had a part-time job, right? You're working a job right now. Do you guys know where your money is going? Or are you asking where it went? So my job as a financial planner is to help people give their job, their money a job, right? A lot of times as adults, we wake up and we go to work and we work really hard and our money is sitting at home on the couch being lazy. We don't want that. We want our money to work just as hard as us. So financial planning is telling your money where to go instead of asking where it went. Now, one of the things that I have to do as a certified financial planner when I meet with clients, the first thing that I want to understand is what are your goals or your values? You guys have talked about values already today. So what are your values? What are the things that you value most? Because the things that you value most will dictate what your goals are related to money. And then your goals, hopefully, will inspire you to action. I have a pop quiz for you. There is no math, but it is a quiz. Let's say there's 3 frogs on a lily pad. One decides to jump off. How many frogs on the lily pad? 2. Yeah, you would think there would be 2. No, there's still 3. Just because you decide to jump off doesn't mean you took the action, right? So goals are nothing unless you take action. 3 frogs on a lily pad, one decides to jump off. It doesn't matter unless you actually do it. And then lastly, you got to get results. I think Devin talked about it earlier. He said you got to be a results-oriented person. Now, all these things add up. When we think about growing the bag and when we think about our money, these things all add up to your relationship with money. I want you to ask yourself, what is your relationship with money? By the time I finish my presentation today, I want you to be thinking about your relationship with money. I'm going to tell you a little bit about my relationship with money growing up, right? So Keith says we grew up together. Keith grew up down the street. They had a nice house. I didn't have a nice house, right? I grew up off a dirt road, and I had a lot of shame and embarrassment about that because I didn't have money, and I had a lot of material things that I saw my friends have that I wanted that my parents simply couldn't afford. Now, don't get me wrong, I had amazing parents. My dad told me I could be anything and do anything, and my mom gave me the discipline to do it. And I'm from Virginia, so you know what I mean when I say the discipline, right? But the one thing they couldn't give me was some of the material things that I wanted. Like I wanted Nikes. My parents bought Sykes. I wanted Fruit Loops. I got Fruity Rings. I wanted Lucky Charms. We got Enchanted Forest. They don't even make that anymore, right? So all these things that I wanted, like if I wanted to go to the movies, I wanted to go on a Friday night. We couldn't go on Friday night. When did we have to go? Saturday in the afternoon, because it was matinee, because it was cheaper. So because I heard no so much as a kid, guess what happened when I got to the NFL and I started making money? I wasn't telling myself no anymore because I had enough money to tell myself yes to everything. In fact, I remember I got my first paycheck from the New York Giants. And by the way, they literally come and hand you a check in the locker room after the game, right? They hand me my first check. I went and cashed it, went straight to Best Buy. Bought me a T-Mobile Sidekick. $17,000 was my first check he asked. I had never seen that much money because they pay you per week in the NFL. So they divide your contract by 16 weeks at the time, or 17 weeks at the time, and they pay you every week that check. Went straight to Best Buy. Spent the whole check almost. But the point is, I developed a relationship with money where I never told myself no. And I had to learn through financial literacy and education and sitting in situations like you guys are in right now, I had to learn how to manage my money, right? So Mr. Williams said, learn to manage your money. This is one of the things that we're going to talk about because I want to help you create some intentionality with your finances, right? Because you guys are in an amazing place right now, and I'm going to explain why you are in an amazing place. Now, I'm going to go through this really quickly just because I know that we want to promote careers with you guys. I tell you a little bit about, again, financial planning and my career. We're based in Charlotte. We have clients all over the country, and we essentially help people figure out what their goals and objectives are in these cornerstones of financial planning. The 4 cornerstones are cash management and liabilities. So we help them figure out how they manage their cash flow, pay off debt, or buy those big ticket, expense items or second homes. Then on the right, we make sure they have all their insurance strategies in place. So we look at protection. In the lower left, this is what we're going to talk mostly about today, investments to grow the bag. And then lastly, we talk about taxes and estate planning. The estate planning piece is very important because it takes 5 generations to build wealth, but only 1 to lose it, right? So we talked about generational wealth. Now, before we have any conversation with anybody about investing money, there are some very important things that you got to do right off the bat, all right? The first is, do you have an emergency fund? Now, who wants to give me an example of what a potential emergency could be? Help me out. No, this guy. Tell me. Emergency. Yeah. Your car breaking down, right? So do you have money to meet that emergency? Do you guys know that in America right now, 70% of Americans do not have enough money to meet a $1,000 emergency? Now, here's what I know about emergencies. They typically happen when you don't have an emergency fund. If you had an emergency fund, you probably don't have an emergency. That's how it works, right? Or do you? You probably still have an emergency fund, but it doesn't feel like an emergency because you have money set aside to handle it. All right, so think about a rainy day fund, to put it in layman's terms. The other thing, before I'm gonna let you invest any money to grow the bag, you can't have any consumer debt. So if you have credit card debt, we're gonna pay that off before I let you invest any money. Do you know why? Anybody wanna guess what the average credit card interest rate is? Anybody? Same hands going up. I like this. Yes, sir, in the back. 8%? That would be amazing. It's not. You're close. Higher than that. Yes, sir. Close. It's actually 24%. It's the average interest rate. Now, who knows what interest is? You guys all know what interest is, right? It is the price of borrowing money, right? I think it was Albert Einstein that said that compound interest is the ninth wonder of the world. He who understands it earns it, and he who doesn't pays it, right? So there is no investment that is gonna pay you 24% on an annual basis. So if you have a credit card or some sort of consumer debt that is costing you 24% a year, we gotta pay that off first, all right? The other one is make sure you have your insurance protections in place. So if you have life insurance, if you have a family, make sure you have the right auto insurance, because if you have a car accident and hurt somebody, you could get sued and lose all the money that we've grown in your investment account. We don't want that. And then lastly, we gotta make sure that you have a specific goal for why you want to invest money. All right, so somebody give me, who wants to invest money, by the way? Does anybody have any investments already? Anybody investing money already? All right, Juris is, okay, good deal. All right, so who wants to invest money? All right, somebody tell me why. Why do you want to invest money? Tell me your name.
My name's Sydney.
Sydney, nice to meet you.
I want to invest money, so when something important comes up, I'm able to take care of it.
Fantastic, she wants to grow money so that if something comes up important, she can take care of it, right? Like an opportunity fund. I love that. Anybody else? Why do you want to invest?
My name is Micah Edwards. I want it for retirement.
Okay, fantastic. So Micah says she wants to retire someday. How old are you, Micah? 20, yeah. Micah's a sophomore in college, right? And she's already thinking about retirement. I love that. Now, as we think about retirement, I want you to think about it as financial independence, where you can be financially independent of a job, and work can now be optional. So that's one of the big goals that we help clients plan for, is retirement, how to be financially independent one day. Now, you guys have talked about goals in here. I'm sure you've talked about making sure that you have SMART goals. I'm gonna go through this really quickly, but SMART obviously is an acronym. Anytime you set a goal, you want that goal to be specific, right? What exactly are you trying to accomplish? So, Micah, when are you actually trying to retire, right? Then you want it to be measurable. What is the income that you want in retirement, Micah? What would that look like, and how can we actually save to that? You want it to be achievable, something that you can actually achieve, relevant, and of course, time-oriented. All right, I wanted to go through that really quickly because I wanted to make sure that you guys understand that when you're investing money, you don't just invest money for the sake of investing. You want it to be tied to a specific goal. All right. Now let's talk about different types of investments, all right? So of course there are stocks, there's bonds, there's real estate, there's cryptocurrency. I'm gonna talk about all of these, but maybe the most important is time. Who believes time is an investment? Yeah, right? I mean, you guys are investing your time and being here today to improve your career and job readiness. You're investing your time here today to improve yourselves from a financial literacy standpoint. So I love that you are investing your time. That might be your most valuable commodity. Would you guys agree? I mean, who's the one of the wealthiest guys in the world is who? Warren Buffett? You are, my guy? You have gray hair, by the way. But you guys know who Warren Buffett is? Warren Buffett is worth $130 billion right now. Would anybody want to trade places with him? You would? All right, I forgot the most important part. He's 95 years old. He's 95, but he's worth $130 billion. Anybody want to trade places with him? Why not? Might not have enough time, right? So a lot of times I hear people say, you know, money is more important than time, and it's not. Would you trade places with a guy worth $130 billion if he was 95 years old? So your time might be your most valuable asset. But let's talk about my favorite. I'm a stock guy. I love the stock market, right? I love the stock market. You know why I love the stock market? I think it's a miracle. I think the stock market's a miracle. You know why I think it's a miracle? Because, you know, I said earlier, I didn't come from money. I'm not, you know, like a super smart guy, but I own a bunch of companies. And you know how I own those companies? By owning their stock, right? So like, who's got an iPhone, by the way? Awesome. All right, so you guys have iPhones. Guess what? Who makes iPhone? Apple. I own that company. Thanks for your business, sir. You're a heck of a guy. I own that company, right? Now, I don't know anything about microchips or cell phone technology. I don't know anything about human resources and hiring employees at an IT company, but I own Apple. Who's wearing Nikes in here today? Okay, I own that company too. Thank you for your business. You guys are amazing. You helped put my kids in college, right? My oldest daughter is a freshman at Chapel Hill right now. You guys are paying for Chapel Hill. I appreciate that, right? Who's got Duke Energy in this room? Like the energy company at home to pay your energy bill? Are you guys Duke Energy? Yeah, thank you. I own that company too. It's amazing. Yeah, because most people complain about their electric bill. I don't. You know why? I own the electric company. Isn't that a pretty cool thing? Right? So I want you to think about owning stocks as owning a company. It is not a casino. It is not a get-rich-quick scheme. It is an opportunity for you to own a portion of that company. And the more money you invest, the more ownership you have in that company. When you think about owning stocks as owning a company, your entire mindset changes. All right? Now, if I were to own a company, right? So who in here would want to start a company? Who's got an idea for a company? What's your name? What is it? Dejor? Come up here with me, Dejor. Unless you're taller than me, stay seated. No, you can come up. I'm just kidding. All right, Dejor, what kind of company we starting?
I want a company in software development and also teaching others how to develop software.
Amazing. So Dejor, did I say that right? Dejor is going to start a company in software development and also educating other people on software. How about giving Dejor a hand, by the way? Pretty good. I love this company. All right, so Dejor is going to start this company. It's going to be amazing. It's going to be fantastic. How can Dejor make money with this company? Somebody help me out. How does Dejor's software company, what are we naming it? Dejor International. So how does Dejor International make money? Yes, sir. Tell me your name. Aiden.
By selling parts of his company.
Yeah, so he could sell a portion of his company. All right, I like that. That's a very high level answer. All right, what else? What's another way that Dejor can make money with his company?
Seeking investors.
Seeking investors, that's a really good answer. That's actually gonna go into Aiden's answer a little bit. All right, so we're gonna come back to that. What's another way? How does he make money with his company? Advertise, building his brand, but like driving revenue, selling the product, whatever the IT software is, selling the product and making profits, right? So as an owner of Dejour International, he sells enough products each and every year that what happens? He has profits. And as the owner of that company, he gets to take some of those profits and do what? Put it in his pocket and in the bank. You guys with me? So one way that you can make money by owning a company is by just selling enough products and earning a profit. The other way, though, is what these guys just said. The other way is I can sell a portion of my business, or I can just sell my business. So Dejour starts Dejour International. He started it with like $10,000 in his bank account. He grew it into a $2 million business, and then one day he sells that $2 million business. Guess what? He walks away with $2 million. So he bought it low and sold it high. Does that make sense, Dejour? You can sit down now. Thank you. So the two ways that I want you to think about making money with stocks, first off, dividends. If I own a stock, if I own Apple, then as an owner of the company, Apple gives me a portion of those profits every single year. Every time you guys buy cell phones and MacBooks, I get a portion of those profits, and they pay me something called dividends. And I get it every quarter. This is how I pay my electric bill with Duke Energy, because they send me a dividend check every quarter. I just pay my electric bill. You with me? The other way, and I'm going to come to your question in a second, okay? The other way is, again, what I just said, capital appreciation. I could buy the stock at a low price, right? I could buy a portion of the business, Apple, for let's say $10 a share, and now it's trading for $100 per share. If I sell it, now I make $90 per share. I bought into the business low and I sold it high. Are you guys picking up what I'm putting down? It's a miracle. It's a miracle. Because here's the other cool thing about the stock market. I don't have to worry about discrimination. There's no DEI in the stock market. Nobody cares. All I got to do is have money that I have intentionally put into investing into these American companies. That's all I got to do, right? I don't have to interview for the job. I don't have to dress nice. I don't have to do anything. I just have to be intentional about putting my money in these great companies. Yes, sir. Okay, what was your question?
You talking about selling, you can sell this company. Like, will I still have to pay taxes on that?
You do have to pay taxes. That's another class. They got to bring me back to talk about taxes.
Even on stocks too, even if I do this that they gave me, will I still have to pay taxes on that too?
I will get taxed on dividends because remember, it's profit, right? So it's going to be treated like income. It's not ordinary income, the higher level class, but there is a tax rate for dividends that you would have to pay taxes. Yeah, Uncle Sam gonna get his, right? But you know what? If you run into that guardrail out there, they'll replace it next week because you pay taxes. So that's a good thing. All right, the other thing is that there are two types of stocks. Now, I went back and forth on whether or not to include this, and they said, you know what? This is the Leadership Academy. They can handle it. So they said to give you the 201 version. Are you guys okay with the 201 version? Okay, fantastic. So there are two types of stocks that we're going to talk about today. There's growth stocks, and then there's value stocks. Now, who has the stock app downloaded on their iPhone? All right, so I want you guys to pull those out. Does anybody have Android? All right, you have to go to the back of the room if you have an Android. No, I'm just kidding. I'm kidding. So if you have an Android, I can't help you because I don't know how that works. But if you have a friend at the table that has the Apple iPhone, I want you to pull out and download the stock app. So it's built into your phone, and it looks like this. Everybody got this? All right, perfect. And I want you to look at a certain stock because I want to teach you the difference between a growth stock and a value stock. Now, a growth stock, what would you imagine the goal or objective if you invested in a growth stock? What would you imagine the objective is? You want it to grow. So a growth stock is a company that is focused on growing the company. They're not looking, they're taking all their profits and they're reinvesting it into research and development because their goal is to aggressively grow the company. You guys with me? So one of the growth companies that I would say right now is called Tesla. Anybody heard of Tesla? Right? It's a growth stock. And here's how I know Tesla is a growth stock. It has a high price to earnings ratio. They said y'all, I should give y'all the 201 version, so I'm giving y'all 201, all right? Now here's what price to earnings ratio is. So if you pull out that app and you look up the ticker symbol, TSLA, so go to search and go to TSLA. And if you look in this middle section here, all right, if you look at all the data, there's a section called P/E. Now, somebody tell me what Tesla's price to earnings ratio is right now. Can anybody tell me that? Yes, sir. $343. Now, what does that mean? Does anybody know what that means? 343. Let's go back to De Jour International. By the way, guys, this is really, really important. If we go back to De Jour International, let's say that De Jour International is making $1 million a year as a company, and he wants to sell his company to you, all right? 343 price to earnings means that he's gonna put his company on the market for $343 million. Now, would you rather pay 343 times what his company earns every year, or would you rather pay, let's say 10 times what his company earns every year? 10 times, right? So Tesla, their earnings, they have very little earnings as a company, and the stock though is trading at 343 times what the company actually makes. That is the definition of a growth stock. They have little earnings, but the price is really high, all right? So the other one that you can typically see with a growth stock is that they don't pay dividends. They don't take the profits and give them back to the owners. You know why? Because they're reinvesting all the money back into the company. All right, so when we think about growth stocks, there's higher risk typically and less income. Now, the other thing that I want to tell you guys, there's a great growth stock that I love. Anybody get Amazon boxes shipped to your house? Yeah, we got an Amazon table at my house. The boxes come in, we just put them on the table. In fact, I have this thing called Amazonesia. It's where I forget what we ordered, so we don't even know what's in the box. But so Amazon, by the way, I own that company too, so thank you guys for your business. But one of the cool things about Amazon is that that company started in 1997. Do you know that? Or that's when they went public. So going public means that now a private company allows all of us as investors to invest in the company. In 1997, I was a freshman in college, and Amazon went public. Guess how much that stock was worth back then? $18 per share. And if I had invested $1,000 in Amazon in 1997, somebody take a guess for how much money I'd have today? A lot. A lot. How much money today? Seriously. $1,000. In 1997, if I put $1,000 in Amazon stock and just did nothing, just held it until today, 30 years, you'd have $2.7 million today for a $1,000 investment. So all of you folks out there that say you got part-time jobs, I want you to think about how you could take some of that money. I'm not saying all of it, because we got to stay fly, got to go get some clothes, some kicks, but take some of that money and put it in some company that if you just hang on to it for the next 30 years, you might have $2.7 million. Putting your money to work. That is the definition of a growth stock. Now, value stocks are totally different. Value stocks are undervalued typically because they're not necessarily trying to grow the company. They're not in like growth mode. So a value stock usually has a lower price to earnings ratio, right? So they're not trading like Tesla at 360 or 43 times what they make on an annual basis. They're probably trading much lower, like 24 or 25 times what they earn. So if we were to look at a value stock, I would say look at Duke Energy. That's one of my favorites. So if you guys can look at Duke Energy and what is it? 20.06. So you could buy the electric company for 20 times what they make on an annual basis. You got to pay 343 times what Tesla makes on an annual basis to own that stock, right? So you guys see the difference? So the value stock means that they're not trying to aggressively grow. It's not trading on potential. We kind of know what the power company is. Now there's a very important part of this though, and there's something called yield. This is how much the dividend pays on a quarterly basis. So what is the yield for Duke Energy? 3.36. That's a really good dividend. So that means that they have earnings and they are paying you as the owner of that company profits. That's gonna help you grow the bag. All right, now we just talked about investing in individual stocks, but that's hard, right? Because you have to pick the winners. Now, a way for you not to have to pick the winners is to invest in what's called a mutual fund. Has anyone ever heard of a mutual fund? A mutual fund is like a portfolio of stocks, so it gives you diversification. Same with an ETF. An ETF is basically a portfolio of stocks that's already diversified so that you don't have to try to pick a winner. I heard someone mention earlier on the previous call, I think it was Mr. Gums, he said that the company Hubble is in the S&P 500. Has anybody heard of the S&P 500? Did you know what that is? It's an index that tracks the performance of the 500 most valuable companies in the country. So if I didn't want to try to figure out which company or stock was going to be the best stock over the next 30 years, right? Because that might take some guesswork. I could just buy an ETF that invests in the S&P 500. So now instead of owning one company like Apple or having to pick a winner, I can invest in all the 500 most valuable companies in the country, including Hubble, right? Isn't that pretty cool? I think it's pretty cool. Now, bonds are totally different. Anybody want to guess what bonds are before I show it on the slide? Anybody know what bonds are? Yes, sir. It's a safer version of stocks. That's a great answer. Bonds are more conservative than stocks, right? Because if a company goes bankrupt and you lose all your money in your stock, well, you don't get any money for owning a stock, but if you own bonds of that same company, they have to pay you first in a bankruptcy. So bonds are more safer than stocks. But here's the thing. If stocks make you an owner of a company, bonds mean you lend money to a company, all right? So let's say Starbucks wants to build a bunch of new restaurants. They already got one on every block right now, but let's say they want to put 2 on every block in the next couple of years. Well, to do that, they might need to raise money. So they want to borrow money. So they borrow money from us. So if I invest $10,000 in Starbucks bonds, I have effectively loaned Starbucks money. You guys with me? So bonds make you a lender to a company. Now, if you loan somebody money, what do they have to do? They have to pay you back. Unless it's family. Family don't pay you back, all right? Just give it to them. Don't make it a loan. But yeah, if you loan somebody money, they have to pay it back. And they typically will have to pay it back plus what? Plus interest. Because interest is the cost of borrowing money. So bonds will pay you your money back at the maturity date. So they're gonna say, we're gonna pay you back in 20 years It's a 20-year bond. I'm gonna borrow your money for the next 20 years and I'm gonna pay it back to you, all of it, by this maturity date in 20 years. And along the way, because you're letting me borrow your money, I'm gonna pay you interest. Now, if a company has bad credit, right? Let's say there's a company that issues bonds that has a record of not paying their debts, what do they have to do? I mean, do you think they pay a higher interest rate or a lower interest rate? Pay a higher interest rate. So if you find companies that don't pay their bills, don't pay their debts, don't pay their bonds, you're probably going to get a higher interest rate. If a company has good credit and they do pay their bills, they'll pay a lower interest rate to borrow your money. You know who has a perfect credit score with paying their debts? The federal government, the United States. We've never defaulted on our bonds because the federal government issues bonds. That's one of the ways that we make up for our budget deficit in this country, is we borrow money. Has anybody heard we have a national debt? That national debt is like $38 trillion right now. You know what that means? We have, as a country, issued $38 trillion in bonds. But because we don't default on those bonds, it pays a very low interest rate. You guys with me? So, bonds are typically safer than stocks. And then, of course, now we got this new thing called cryptocurrency. Anybody invested in crypto? No? Anybody want to invest in crypto? I'm not a big fan of cryptocurrency. And I will tell you why I'm not a big fan. I'm not saying you can't make money with cryptocurrency. But the first thing I would say is that, has anybody ever bought anything with Bitcoin? Like, have you ever gone to the store and seen a sign that says, Bitcoin accepted here? You have? Oh, wow, okay. That's the first time I've had a hand go up. Most people have never bought anything with crypto, and I've never really seen a store that says we accept crypto. So I don't believe it's a currency in that way. Now, it is an asset that you can use to make money, right? Especially now with the current administration. The problem I have with cryptocurrency, though, is that it operates on what I call the greater fool theory. Because when we think about Apple and that company, how does Apple make more money? What do they have to do for their stock to go up? What does Apple have to do to make more money? Sell products, right? So I know if Apple sells enough iPhones and enough MacBooks and enough this and enough that, then their company is going to be profitable and the stock price is going to go up. All right, let's compare that with Bitcoin. How does Bitcoin make more money? How does the price of Bitcoin go up? People buy more Bitcoin, but how do we get people to buy more Bitcoin? Yeah, so it's greater fool theory. So cryptocurrency means that I'm gonna buy this thing that everybody says has value, and I have to convince the person behind me to pay more for it than I paid for it. I gotta convince Caleb that, Caleb, I paid $50,000 for this Bitcoin. I need you to pay $70,000 for it. So I need you to be a greater fool, right? So that's one of the reasons I don't love cryptocurrency, but that's not saying that you can't make money with it by speculating. All right. And then of course there's real estate. Real estate means that you own an actual tangible asset. So when you think about investments, it's not just stocks and bonds and mutual funds, ETFs, cryptocurrency, it's also real estate. Real estate means you own a piece of real property. It's also one of my favorites because it is a leverage opportunity. Because I can borrow money from the bank, buy this asset, a house, that will then appreciate in value. And when it appreciates in value, the bank doesn't say, wait a second, you got to pay us more money because the value of that house went up. So I got to use their money to grow my money. And typically a mortgage, which you would have on a house, is a much lower interest rate, right? Because it's a long-term debt. So here's what I want you guys to think about when you think about growing the bag, when you think about growing your money, I want you to think about appreciating assets versus depreciating assets. Appreciating assets are what? Assets that grow in value over time, like stocks, bonds, artwork, even jewelry, right? Depreciating assets are assets that lose value over time, like cars. You know, when you buy a car, it's worth $20,000, and in 5 years, what's it worth? If anything at all, right? So think about depreciating assets. I am a big fan. If you're gonna spend your money, if you're gonna grow the bag, don't get caught up in spending money on depreciating assets. Even worse, don't borrow money for depreciating assets. In our family, we drive our cars till the wheels fall off. You know why? Because it's gonna fall off anyway. It's gonna lose value, right? I'd much rather put my money in something that will grow in value. All right. Now, they wanted me to also include some different account types. All right, so I'm gonna go through this really quickly, and then I wanna open it up for questions, and then we're gonna go to a really quick activity while you guys are eating lunch, and I got some prizes for the activity, so you definitely wanna pay attention. So the different account types that we have, so there are different ways that you can invest money. One of the most popular ways that a lot of people invest money is at their company. You have something called a 401k plan, where you can save money in that account specifically for retirement, right? And inside of this account, you can choose your investments, whether you invest in stocks, bonds, mutual funds, ETFs. The other thing is that if you don't work for a company, or if you want to save more money than your company will allow you, you can create something called an IRA, an individual retirement account. It's where I can put my own money in my retirement account instead of having a plan at my company. There's also something magical called a Roth IRA. If they ever have me back, I'll talk to you about Roth, because I'm a big fan of Roth IRA. But Roth IRA means that I can grow my investments and never pay taxes. So you asked that question about taxes. With a Roth IRA, I can pay my taxes before the money goes into the account, let the investments grow, and then never pay taxes on the investments. Now, for many of you, what I would encourage for you to do, if you want to grow the bag and start this process, I would encourage you to open your own brokerage account. Because a brokerage account will allow you, and you can do this at a multitude of places. You can even go to a bank and they'll let you open a brokerage account. So if your parents have a bank relationship, see if they can open a brokerage account for you. But inside this brokerage account, you can invest in pretty much anything. What I would advise you to do is invest in things that you use. Because I want you guys to, instead of thinking about being a consumer, right? It's good to be a consumer, but I want you to think of being an owner. Instead of being a consumer, let's be owners. So own the things that you use. So I would start with, like, if you wear Lululemon, buy Lululemon stock. If you eat at Starbucks, buy Starbucks stock, right? If you eat at Chipotle, buy Chipotle stock, and get used to being an owner. Last slide, a goal properly set is halfway reached. So I want you guys to go back to that slide where I said you want to set smart goals. Set a goal for how much money you think you can save and invest on a monthly basis, especially if you have a part-time job. So set a goal. If your paycheck every 2 weeks is $200, maybe just put $50 in is that too little? I'm out of the loop, man. I'm out of touch. I'm sorry. But if you got $200, right? Maybe try to put $50 in stocks every single month and set that goal. And I promise you, listen, if I could go back in time, I know the stocks that I would buy, right? And we'd all be having a different conversation. So